So I wanted to talk a little bit about why we make so many mistakes, because that point in 2008 was the motivation for me to go and set up the Stockopedia site so that I never ever had those issues again. I want to talk a little bit about understanding the mind and how the mind works, and we'll talk about some of the behavioral biases we have that cause all of our problems. So we'll talk about overconfidence, we'll talk about attention blindness, we'll talk about how we're suckers for stories and we're suckers for gurus, and we'll talk about something called loss aversion, etc. And then hopefully at the end of it we'll get a little bit of time to talk about how we can manage the monkey mind better so that we make better decisions in future. And if I get time at the end, I did actually pick 5 shares last year on this stage, and they've done quite well. And I will hopefully leave you with another 5 selections at the end of this, because it would be too fun. It wouldn't be fun not to. Anyway, again, you've probably seen a couple of disclaimers today. Very much educational session. You're all grown-ups, DIY investing. This is non-advisory. Please make your own decisions. Okay, once again, I want to check that the tech is working. So if you go to that URL, now with any luck this will work. Yes, okay. I would like you to check your smartphones, and if you can answer this question, it would be very helpful. You should see some multiple choice questions. And it's how many animals of each kind did Moses take on the ark? Please answer it as quickly as you can. This is marvelous. It's working. I'm really excited. Well, I think I'm going to have to shut that down now. That we've had a lot of answers come through. I think we had maybe 100 of you. That's brilliant. Here are the results. Yeah, it's working. It's a blank screen. No, there we go. How many animals of each kind did Moses take on the ark? Well, the people who said 50,000, I don't know what they taught you in Bible studies. Right, oh no, now you're all changing it. Look, you're all backing out. So 56% of you have said that they took 2 of each kind into the ark. So apparently you were all taught that Moses took 2 of each kind into the ark. Does anyone want to tell me what's wrong with that? It was Noah. Only 10% of you actually got the answer right. And I'm cutting that off because look, you're all changing your answers. You've all just fallen hook, line, and sinker for something called the Moses illusion. Okay, you put yourself in the way the mind works. It puts you in a context, and you were put in a biblical context, and you thought Moses Ark sounds all right. And anyway, this is just this is the first trick of the mind that I'm going to show you today. But actually, that was a pretty innocent mistake. There are a lot of other mistakes we make which are much more expensive. So why do private investors make so many mistakes? There was something Benjamin Graham said. Now, if you don't know who Benjamin Graham was, he was the father of value investing. You wouldn't actually be here without him. And he was the tutor of Warren Buffett. He's tutored more billionaires than I think anybody else on the planet. And he said the investor's chief problem and even his worst enemy is likely to be himself. Now, in the last couple of weeks, and in fact, every couple of weeks that you see through the year, there always is a popular stock which collapses. Okay, and this one is one which, I don't know if anybody owned it here, I'm not going to do a hands up, but it's African Potash, fell 45%, a very popular stock on bulletin boards. We saw another one called Snoozebox collapse, on Monday the CEO resigned. Snoozebox had the great idea of turning containers into hotels and parking them at F1, Formula 1 and big events. But it didn't work, no profits. Well, it hasn't worked so far, it might work in future, but that's lost 90% over the last 6 months. These are something that I like to call sucker stocks. They tend to be very speculative, they tend to bleed money, require a lot of capital, and they're very unprofitable. Now the thing is, I want to do a hands up here, not just going to sit on this smartphone thing. I want you all to think, right, if you had a choice between buying a good, cheap share in this hand and an expensive junk share in this one. So you've got a good, inexpensive company. It's profitable and it's inexpensive. And on the other hand, you've got a very expensive, unprofitable, loss-making company. Hands up, who wants to buy the expensive, unprofitable junk share? Go on. You've got it. Go on. If anyone puts their hand up, they're coming up to explain themselves. Right, hands up, don't be shy. Who would buy the good cheap share? Right, anyone who didn't put their hand up, I don't know. But anyway, I think it's pretty common sense what works in investing. We understand, we know it. We go to the market, we know how to actually make pretty sensible decisions with our money. We try and buy quality at a good price. Now, if I was to show you this chart, some of you who've been here before or come to any of my seminars before, what I've got here is value on one axis, which goes from expensive to cheap, just like we were saying. And on the vertical axis, we've got quality, which going from junk to good quality, okay? So if you think of it like this, you've got good, cheap stocks up in the top right-hand corner, and in the bottom left corner, you've got expensive junk stocks. Now, I think all of you have just said the kind of shares that you'd want to buy would be in that top right corner, right? None of you want to be in that bottom left corner. Well, that's exactly what you see in the portfolio of a great investor. This is a portfolio of a friend of mine called Gary Channon, who runs about $500 million at Phoenix Investment Management. He has done about 17% annualized since the year 2000, and he knows a bit about this. He's very much a Warren Buffett kind of investor, and I think we can all appreciate he's doing what we all put our hands up and said we do, okay? The problem is, if you look actually at the 100 most discussed stocks on UK bulletin boards, and you plot them on this chart where each blue bubble is a stock, this is what it looks like. So that is what private investors like to chat about. They like to chat about expensive junk shares. So they do the opposite. In fact, this is 100 shares, so in that green area up there, there's only 4% of the shares that are talked about on bulletin boards in the UK are good, cheap shares, okay? So if you go out online reading about stocks that other people are talking about, beware. This is, and I've been tracking this portfolio of most discussed stocks for a long time, the last couple of years, and this red line shows the performance of the UK's most discussed stocks over the last 2 years. You can see they've actually returned minus 22%. The FTSE All Share hasn't done so well either, but at least it's almost flat. But it gets worse, because you all come to these investment shows and you listen to Nigel Ray and he'll say, you've got to go and assess the quality of the management and go and meet them and all of that sort of stuff. Now, I think it's wonderful words, but he does get to meet the best companies in the world. If we look at the UK Investor Show exhibitors, they plot like this. Cue Tom not inviting me back next year. There is one up there that you've all said you'd be interested in buying, one good cheap share. Not telling you which, I will tell you, it's Interquest. But anyway, the problem is the returns to UK Investor Show exhibitors have been even worse. Been minus 30% in 2 years. It's been a bad time for miners and explorers. But my point, I think, is pretty clear. If you had invested in good, cheap shares, you would be looking at more of those kind of returns in that green line, which are much, much higher. So I think this is a very, very important point. The other thing about private investors is they tend to have we as a whole as private investors tend to have portfolios which look a bit like this. And it's a gross generalization, but there was a study done of 66,000 brokerage accounts in a big US brokerage by a couple of chaps, academics called Barber and Odeen. And they found the average investor owned 4 stocks, pretty much in a single sector, and they trade 75% of their portfolio annually. Now, I have to admit, that's what my portfolio looked like in 2008. I'm very glad to say I've recovered since then. And I think most people think they're very, very smart when they buy kind of like 4 really respected stocks in the same sector. But it always comes back to burn them. So anyway, that is the kind of thing we're going to try and avoid. If you want to have better performance than the crowd, you must do things differently from the crowd. That's a quote from Sir John Templeton. I don't know if anyone knows Templeton Asset Management, but he became a billionaire. He knows his stuff, and that is what I'm hoping we're going to learn now. So I want us to have a little bit more time and spend a little bit more time polling and having fun with our smartphones to understand the human mind. Right, I've got 3 questions for you, okay? Please do these, go back to pollev.com/stocko, and you will find the first question there. I'm not going to give you very long to answer this. A bat and a ball costs £1.10 in total. The bat costs £1 more than the ball. How much does the ball cost? So please answer as quickly as you possibly can, because I'm not going to give you very much time. I'm waiting, they're still coming, they're flooding in these answers. Speedy. Right, 5, 4, 3, 2, 1. Next question. If it takes 5 machines 5 minutes to make 5 widgets, how long would it take 100 machines to make 100 widgets? Simples, right? Bet you didn't think you'd be doing some maths today. You're finding that one harder. Okay, next question. In a lake, there is a patch of lily pads. Every day the patch doubles in size. If it takes 48 days for the patch to cover the entire lake, how long would it take for the patch to cover half the lake? Can you see it? You're all. Hang on. I told you there would be technical issues. Right. There are some answers coming in now. I think you should be able to see it. You're much better at this one. Come on, come on. Going to give you 10 more seconds. Pump it in, pump in. You can't not answer. 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. Done. Right. Now, I'm taking that question off. Okay, thank you very much for answering those questions. I will show you the results in a minute, which will be quite enlightening. Now, I want to talk a little bit about the brain. I'm sure we all know this. There's a wonderful little book called The Chimp Paradox, written by Steve Peters for the layman. But Dr. Steve Peters, he actually coached the UK cycling team in terms of their psychology. And we all know how well British cyclists have done in the last 10 years. And a lot of that is down to the mindset that he's put into these cyclists. But the brain can be thought of as having this bit of the center, which is called the limbic brain. And it's the limbic brain that we share with reptiles, with all of the animal kingdom. The frontal cortex, this bit at the front, is what makes us human. It's where the conscious mind really develops, and our frontal cortex is far, far, far bigger than any other species of animal. So you can think of basically this monkey mind being in the limbic part of the brain, and the human part of the brain at the front. Now, what happens when you get a input is that the limbic brain, the monkey mind, will be the first to act. Only after things have been processed by that limbic brain will the frontal cortex actually take over. And it's quite interesting because this has been called System 1 and System 2 by Daniel Kahneman in his terrific book, Thinking Fast and Slow. System 1, that monkey brain, is fast, it's automatic, it's intuitive, it's emotional, very active. Okay? Whereas the frontal cortex, it takes effort. You just did those questions. I saw you changing your answers. It's more considered, it's more logical, effortful, and it's lazy. It takes a lot of energy to get it to work. We don't like practicing it. Now, the 3 questions you've just answered is actually called the cognitive reflection test. It assesses an individual's ability to suppress an intuitive but wrong answer in favor of an effortful but right answer. Yes, I admit they were trick questions. But we shall now see your answers. Come on. Give me the answers. Yay, okay. This first question. A bat and a ball cost £1.10 in total. All well, 66% of you went for 10 pence. If the bat was £1 more than the ball, that would make the bat £1.10. £1.10 plus 10p is £1.20. You got the maths wrong. It is actually 5p is the right answer. 5p plus £1.5. But you can see it was framed in a way to trigger your System 1. Okay? The second question, you actually did much, much better at. The correct answer was 5 minutes. But still, almost 50% of you got it wrong. And actually, I think if I hadn't done this as a multiple choice, I think there's clearly a lot of you guessing, because the intuitive answer is 100, but people were going for 20, for 1 minute? Crikey. The third one is, okay, this is a fun one. The correct answer is 47. If you've got lily pads on a lake and it's doubling every day, well, obviously on the day before the lake is fully covered, 47 days is the right answer because it's half. But you can see how many of you went for 24, which is like half 48. That's the intuitive but wrong answer. Okay? Now, did you know that in general, 33% of the population will get all 3 of those questions wrong? They are designed to trick you. So, but it is a great test of how well your System 2 takes over. Now, you can train yourself to think differently. And you would hope that fund managers, yes, those extremely, extremely well-paid people that drive Porsche Cayennes and are rather pleased with themselves, you would think they would get all these questions right. The truth is, only 40% of them do. The average fund manager only gets 1.4 questions right. And that's from James Montier's study, and he's asked a lot of fund managers. So they really aren't actually as good at this as you think. They are as subject to these issues as all of us. The key takeaway here is that under pressure, the system one, the chimp mind, the limbic brain, will dominate decision making. And if you think about the stock market is a kind of, it's a hotbed for putting pressure on you. Your stocks are moving so fast every day. Sometimes it crashes. And in those situations, actually making wise investment decisions is very, very, very hard. The chimp is not designed for investing, and he will sabotage your portfolio. That will happen. And the other thing is, if you're feeling quite smug because you got all 3 questions right, the truth is, you're training your chimp to be a bit cocky and a bit overconfident. And the overconfidence is even more expensive because you will believe your own BS. Sorry, excuse my French. Anyway, let's move on and talk a little bit about overconfidence, okay? The next one is not a trick question. This is just, I want to poll this, okay? Okay, wait, before I do actually, I want you to think how many unique pieces of information you need to make an investment decision. So think about it, all the bits of news, annual reports, looking at, do you look at bits of data, how many unique ratios you need? Think about how many unique pieces of information you need to make a good decision. Crikey, you don't work very hard, do you? Okay, oh right, you're still there. Right, I'm going to shut that off. Actually, this is actually quite promising. Here's the results. About, crikey, 45% of you are saying 5 bits of information. And, oh look, here come, go on, answer it quickly. Oh, you can't make your minds up. Actually, I don't know if we're private investors, we're time poor. I would ask you what bits of information you do need, but actually, it's quite interesting because there was a study done of bookmakers, who do odds, and they were given all these bits of information they normally need to set odds on horses, and they were told to rank them in order of importance. And when they were given the top 5 bits of information, some horses they were given 5 bits of information to. Which is over here, to make their decision on the odds for a horse. And some were given 20 or 40 bits of information. You can see this black line shows that the accuracy did not improve as a function of the information. The more information people are given, they don't make more accurate results. Whereas if you look at the dotted line, that's their confidence. Their confidence skyrockets. So whenever you own a stock, and often, when we do own a stock, we find that we just gather more and more and more and more information. We become more and more confident on our holding, and we get blinkers on. And this is actually can be an expensive mistake. As Mark Twain said, it ain't what you don't know that gets you into trouble, it's what you know for sure that just ain't so. We're going to explore this a little bit more. Benjamin Graham, who we talked about previously, he believed you didn't need much information to make a good decision. Like we were talking about earlier, you need things to be good and cheap. My point is to avoid over-researching. It won't necessarily make you a better investor. I know some people will disagree with me. Favor simplicity over complexity and stop following your stocks obsessively. Right, now I'm going to have some real fun with this next one. I want to test, because I don't think that you guys can all pay attention, all right? I think you've got a problem, you might have a problem with attentiveness. So I want you all to watch this video. You're going to see 2 teams of basketball players, 3 in each team. Some are dressed in white, some are dressed in black. And I want you to count how many times the players wearing white pass the basketball, and I'm going to poll you on it. Okay? So please count as accurately as possible how many times the players wearing white pass the basketball.
The players wearing white pass the basketball. How many tests.
Brilliant. Right, now please go back to your app and put in your answer right now. Can you now answer the next question? Okay, this clearly doesn't work as well in the group. Luckily, I'm not showing you I don't actually have the slide to show the answers. But actually, 50% of you did not see the gorilla. Okay? There was a big, hairy gorilla that walked straight across the screen. Have a look at this. There he is. There he is. You weren't quite spotting that, were you? He beats his chest and he walks on. You were too busy watching those blooming basketball players. The key point to this is you could be missing the obvious. Every time you get blinkers on and you concentrate very hard on something, and I tell you, people concentrate very hard on their stocks, you're missing the obvious. You must seek out contrary opinions, and you must ask what you're missing in all your investing. It's called inattentional blindness, and it happens to us in everyday life. I'm sure all of us have always had that experience where you buy a car or you buy some brand, and then suddenly you see it everywhere, and you miss that in everyday life all the time. There is so much that we miss. And genuinely, we are actually, even beyond this, we are suckers for stories, okay? We are, our human mind is actually designed for narrative. You think about, we evolved probably around campfires telling stories to each other, and we still tell stories to ourselves all the time, the cinemas, etc., everywhere. And this desire for good Hollywood endings in everything we do is actually very, very expensive. We believe in these massive grand themes and grand narratives. You know, the 2000 dot-com bubble was a huge, grand story, sucker story that we all fell for hook, line, and sinker. Yes, technology's changed our world completely, but not how we thought it did back then. 2007, China and renewables was the big bubble of the time. 2011 was the commodities super cycle. There are still so many portfolios stuffed full of commodity stocks as a result of believing this kind of chart. Now, this is a chart of world mining earnings forecasts. You can look at the black line, and that's the actual earnings. In 2010 or so, that was the projection. And, you know, Jim Rogers and all these other global gurus were peddling this myth that we're going to see this super cycle forever that was going to lead to 13% annualized performance. It didn't happen. And the truth is analysts are wrong by an average of 47% a year. So every time you go and look at an analyst's forecast, it's possibly way out. This is a study by James Montier again. On a 2-year basis, they're 97% out. So that's quite worrying. Right, and I wanted to explain a little bit about how, this will be quite fun. Let's do this. Okay, I want to split you in half, okay? I want everybody on that side of the audience to close their eyes. Okay? Please close your eyes and don't answer the following question. Everybody on the left, open your eyes and look at the app. Don't worry, you will all get your chance with your eyes closed in just a minute to answer a question. So everybody on the left, please answer the current question. I appreciate it's quite a calculation, quite intense calculation. No peeking on the right. So make your best guess of doing that multiplication. Now, I just want you to, I'm not going to give you lots of time to calculate it. Just do your best. Take a wild guess if you have to. Okay? Giving you another 10 seconds to answer it. Okay, good. Giving you 5 more seconds. Take a guess. 5, 4, 3, 2, 1. Done. Okay, stop. Okay, you can all shut your eyes on the left now, and everyone on the right, please open your eyes, go to the app, and answer the question that you see. It's a multiplication puzzle. I'm not expecting everyone to get it right, but I want you to take your best stab, and I'm going to give you about 20 seconds to do it. Five, 4, go on, take a guess. 3, 2, 1, 0. Right, thank you very much. Right, we're going to have a quick look at these answers. Okay, what you've both done is everybody on this side of the audience has answered the question 8 times 7 times 6 times 5 times 4 times 3 times 2 times 1. Everyone on this side of the audience has answered 1 times 2 times 3 times 4 times 5 times 6 times 7 to 8. The same question flipped, okay? Now, this is the first one. Someone has got a really big number, but you can see the sort of range that the answers are in. You've kind of got around between a few hundred and a few thousand in general. If you look at the next one, you see much, much, much bigger numbers in general. I don't know who put 5. That must be a mistake. I mean, it started with 8. But you see enormous numbers. And actually, when I've analysed the averages, there tends to be something like a factor of 30 times difference in the average response. And all that is happening is that those who are doing 8, 7, 6, 5, 4, 3, 2, 1 get anchored on the idea that it's a bigger number early. Everyone on the other side get anchored on the idea that it's a small number early. And you can think about analysts, when analysts are projecting forecasts, this is what happens with them. This is a chart, and the black line, the one that isn't dotted, shows you earnings, the current earnings in the economy over time. Whereas the dotted line shows you the forecasts. And we can see that this is the average across all analysts. And you can see the analyst forecast, it's like exactly the same chart, but just shifted to the right. They are completely lagging reality. Analysts actually they're trying to forecast, and they can't forecast at all. What they are doing is they're anchored on the current value of earnings per share that they already see. They are completely lagging reality. And this is a serious problem. Anyway, long story short, analysts are generally wrong, so don't rely on their forecast. Don't get anchored on price target just because someone said it. And beware of paradigm shifts. Right, I've got one more thing I want to talk about before I talk about strategies for dealing with all these issues. And this is about running winners and cutting losers. It's something that Nigel Ray brought up, and it's something everybody is really, really, really bad at. Okay. Now, I've got 2 quick questions. I want everyone to answer these ones. Which of the following would you prefer? A £500 guaranteed win, or a 50% chance of winning £1,000, and a 50% chance of winning 0? So I'll either give you 500 quid, or there's a coin flip, and you either win £1,000 or 0. Which would you rather take? And there's a pretty clear-cut answer coming through here. You're finding that one very easy. Right, next question. Okay, stop. No more answers. Next one, we're going to do it the other way around, right? Losses. Which of the following would you prefer? A £500 guaranteed loss, or a 50% chance of winning £1,000, a 50% chance of winning 0? See what I mean? Do you want to gamble on winning a lot more money, or would you want a guaranteed loss? You've got to take it. Go on, answer the question. Anybody? Are you seeing it? You're puzzled on that one? Not there? Hang on, let me try again. Okay, cool. Guaranteed loss of £500, or gamble on losing nothing? Give you another 5 seconds to answer that one. 5, 4, 3, 2, 1. Great, done. Okay, here's the results. Okay, I think most of you have gone for the win. 500 quid guaranteed, and you'd take it right there. I certainly would if someone came up to me and offered me that. Only 13% want to gamble on £1,000, okay? I know you've got too much money for sense. I just wanted to gamble on losing nothing. Now, of course, you can think about both these questions. Both answers have the same expected average return, right? 500 quid or, 0 plus 1,000 is 500 quid. So we should actually be, there should be 50% in each case. But what I want you to think about is looking at what happens in your portfolio every day, okay? What happens in your portfolio every day is something like this happened in a week last year, when we had 2 shares, Dark Group and Cinity, which both announced different results, etc. And Dark Group had some positive news, and it popped up 18% on the day. Cinity dropped 35% on the day. And what happens when you go into your portfolio and you look at shares like that? You see that one of your shares has popped up 18% on some quite good news, and you think, oh, guaranteed win. That's 500 quid right there. If you sell it, you get 500 quid right there. If you hold it, what happens if it goes back to nothing? You're gambling on winning or losing. So most people will have a tendency to take and bank that guaranteed win. Whereas on the loss, what happens is that most people, they won't want to realize the loss. Because if you accept that 35% loss, you're saying that's a guaranteed loss. And we've just seen none of us like guaranteed losses. Everybody was more likely to gamble on the loser coming back. And this means that we tend to cut our winners and run our losers. And this is a terrible, terrible issue. So when everyone comes out and sort of says, run your winners, cut your losers, it's actually very, very hard psychologically to do because of precisely what we've just discovered. What actually happened a year later is that dark group went up 106% and Synity continued to fall. So cutting your winner and running your loser would not have been the right play. And this happens a lot in the stock market. It's called the disposition effect. You really should sell your losers and don't sell your stocks if they have sudden price rises, unless they're the kind of stocks that are exhibiting here today. Right. Help, I'm an idiot, get me out of here. Right, okay, if we can all agree that we have certain mental flaws, and I could go on for about 4 hours with these kind of fun games, but fortunately we can't. We have to have strategies that put us, that can protect us from our monkey mind, from that limbic brain taking over in all these situations. Something Ben Graham said, back to Ben Graham, he's always the font of wisdom. People don't need extraordinary insight or intelligence. What they need most is the character to adopt simple rules and stick to them. I'd like to put a hands up. How many of you have a predefined buying checklist that you run every purchase through? Be honest, in your portfolio. Okay. Everyone look around you. There's only I'd say it's less than 5% of you that do. And everybody else doesn't. They don't have a defined, strict checklist that they put their purchases through. Ben Graham, 100 years ago, was saying, that's what you need to do to basically become a billionaire like, he did. Charlie Munger, billionaire, Warren Buffett's partner, Berkshire Hathaway. Checklist routines avoid a lot of errors. There is no other procedure in the world that will work as well. Checklists are used in surgeries. Their checklists are used by airline pilots when they're taking off. They actually can help you stop disaster in your portfolio. And so the thing I wanted to say is give 3 key rules for people if they want to improve their investment results. First one is to define some entry rules, define some purchase rules. Look, we were talking about have a measure of quality and value, good, cheap shares. Okay, and if you can't measure what is cheap and what is good quality, you are running a bit blind. You are possibly going to be you're going to buy based on the story or the charisma of a CEO. So create a simple, repeatable process, and that's a really, really good a bit of advice. Diversify risk. Don't fall into the trap where you have 4 or 5 or 10 stocks in the same sector, or what some people do, which is buy 25 stocks in the same sector. That is not diversification. You need to spread your risk across different sectors or even asset classes. And thirdly, the one thing nobody ever talks about is exit rules. You must have exit rules. Otherwise, you'll have a problem like I did in 2008, where I thought I was such a genius, my stocks had gone up so high, that I decided I didn't need any exit rules. And that hurt. So I do believe in having some form of stop loss, which, as I said, if you do use stop losses, you will be fighting that tendency for us to gamble on our losers. I know, yes, it might have got you out of Domino's Pizza, but you could have always got back in. The other thing is to rebalance. If you have buy rules and you have a measure of good quality and good value, you can always assess your holdings on a regular basis for whether they still meet those criteria. Okay, and if they don't, that's an exit rule. So I think that's very, very important. There's lots of other things you can do, like, for example, trade less. It's very expensive trading. You can keep a trade journal which will prove to you whether you lie to yourself or not. You can switch off. Don't look at the news every day, and don't look at your price changes every day, because that's an expensive habit. Don't talk to anybody unless it's contrary opinion, because we already discovered that if you go and talk to all the other people, all the other private investors in Britain, you've only got a 4% chance of finding one of those shares that we like, the good cheap shares. And the other thing, ignore forecasts and ignore broker estimates. And the other thing is defer to your wife. Women are actually much better investors than men. For some reason, men run the money, and it's all the wrong way around. Don't know why. It's actually been proven that women are actually better investors than men. So anyway, I'm going to talk. If you want to learn more and learn about how to construct buy rules, I'm doing a couple of seminars this afternoon upstairs. I've got one at 1:20 and one at 2:40. But here's an example of a very, very simple checklist that works by James O'Shaughnessy, who's a very famous US investor. And this is called his Tiny Titan strategy. And it basically looks for cheap shares that are rising in price that are small. And it's done about 150% over the last 4 years. Really, really impressive stuff. And that is the power of having a simple, repeatable process. Anyway, I don't want to talk about this anymore. I hope that I've given you some good ideas that you can think about and take away with you. I will quickly review last year's picks because I had 5 stocks. I'm trying to remember what they were. Barclay Group did quite well, up about 8%. H&T up about 30%. And then we had Empresario up, I don't have the exact numbers, but on average, they were 12.4% up. FTSE All Share down 8%, and that was 5 shares. The worst one was Indivior, that fell about 15%. But that's 20% outperformance versus the All Share. So I'm going to leave you with 5 picks for today, which are not, now I don't use I don't actually research these stocks. I use my systems to research them. But they're using our measures of value and quality and momentum to come up with these ideas. And this is my entire personal investment system that I use. And it's called the Stock Ranks, but you don't need to know that. And this is this year's selections. And I'll be very interested to see how they do next year. I've made sure they are all in different size categories. And I've made sure they're all in different sectors. So you've got Persimmon. Everyone knows Persimmon, PSN. Computer Centre, CCC. Headlam, HEAD. Gem Diamonds, GEMD, and H&T Group. Now, these are the top ranked shares in each of these size segments, and I'll be checking them out, hopefully, for next year's show to see how they've done, see if my luck doesn't run out. Anyway, that's it. If you want to learn more, come up to the Stockopedia stand. As I said, I'm doing seminars at 1:20 and 2:40 to explore these ideas later. I hope it's been fun and a bit different. Thank you very, very much.